On a quiet night, a man opens his retirement account and sees everything he trusted moving the wrong way at once. Stocks are down, bonds are down, cash feels smaller every month, and in the back of a drawer, an old gold coin sits there doing absolutely nothing, which is exactly why it starts to matter. If you like staying close to the moments when money stops sounding like numbers and starts sounding like a warning, subscribe and stay with this channel, because this story is not really about a medal. It is about the shock of learning that the system you trained yourself to trust may no longer reward the habits it once did. And once you see that, the title starts to feel less dramatic and more like a diagnosis. When Ray Dalio says gold is not broken, he is not trying to turn you into a treasure hunter. He is pointing at something much more uncomfortable. He is saying the asset did not fail. The mental model did. For years, the normal plan felt simple. Work hard, save steadily, keep some money in cash, own some stocks for growth, own some bonds for safety, and trust that central banks would smooth out the worst storms. That was not a crazy idea. In fact, for a long time, it was a very good one. But good plans are often children of their era. They work because the world around them supports them. Then the world changes quietly, then suddenly, and the plan keeps walking forward as if nothing happened. That is when people confuse familiarity with safety. Gold makes people uneasy because it just sits there. It does not send you a dividend. A dividend is a cash payment a company gives its owners. Gold does not pay interest either, which is the income you earn from lending money. So why has it survived empire after empire, currency after currency, crisis after crisis? Why do central banks still hold it? Why do families across cultures still hide it, gift it, and return to it when trust starts to thin out? And those are not old habits without a reason. This matters far beyond investors with trading screens. It matters to teachers, truck drivers, nurses, engineers, and retired couples who thought their savings had a safe lane. It matters to workers who spent 30 years following rules that made sense in a world of falling rates and cheap goods. It matters because a broken playbook does not announce itself until ordinary people are already standing inside the damage. The last few decades trained people to believe in a certain rhythm. When growth slowed, rates fell. When rates fell, bonds rose. When money got cheaper, stocks recovered. And if things got ugly enough, policymakers stepped in and flooded the system with support. That rhythm shaped almost every popular idea about safe money. A bond was supposed to steady the boat. Cash was supposed to buy time. A balanced portfolio was supposed to soften the blow. And gold was often treated like a relic, something dramatic people reached for when they had lost perspective. Then the rhythm cracked. Inflation came back with real force. Inflation means the money in your pocket buys less over time. Suddenly, the assets that were supposed to protect people from chaos started moving together in the wrong direction, and the old map began to tear in public. Have you noticed that the safest plans usually break not when people are reckless, but when they are most disciplined? If that question keeps pulling at you, stay connected here, because the rest of this story explains why. The danger is not only losing money, the deeper danger is using a strategy built for a climate that no longer exists. To understand why gold keeps returning to the scene, you have to look beneath prices and into structure. Modern finance runs on promises. A bond is a promise. A bank deposit is a promise. Even many forms of wealth are somebody else's liability, which means they depend on another party staying sound. Gold is different. It is not a promise to pay later. It is not someone else's debt. It does not need a central bank meeting, a government budget, a board vote, or a healthy borrower to remain what it is. That sounds abstract until a debt-heavy world starts to strain. And right now, strain is everywhere. Governments owe too much. Households in many places owe too much. Companies learn to live on cheap credit, and cheap credit is no longer cheap. Debt matters because the system has to choose how to carry it. You can pay it honestly through growth and discipline. You can restructure it, which means changing the terms because the original promise no longer works. Or you can soften it through inflation and currency weakness, which is a quieter way of making old debts easier to bear. That quiet option is where many savers get trapped. They think they are being careful because the number in the account does not fall. But if prices rise faster than the value of the money they hold, they are losing purchasing power while still feeling responsible. The loss is real, even when it looks polite. Take a woman named Linda. She is 64, 2 years from retirement, and she did everything people told her to do. She kept her emergency fund, bought broad index funds, added bonds for balance, avoided wild speculation, and assumed that caution would be rewarded when the time came. Then inflation hit her grocery bill. Insurance climbed, property taxes rose. Her bond fund fell at the same time her stock fund fell, and the cash she kept for safety felt smaller each quarter. She was not reckless, but she still found herself asking the question that haunts every saver in a changing era. How can I be more responsible than ever and still feel less secure than before? That question is where gold enters the room again. Not because it solves everything, but because it belongs to a different category of asset than the ones most people were taught to rely on. A lot of investors spent years laughing at gold because it looked unproductive. And compared with a great business, that is fair. A great business can grow, innovate, and compound over time. Gold does none of that. But a portfolio is not only built for good weather, it is built for different weather. That is the part people forget after a long sunny period. If every part of your plan depends on stable prices, falling rates, trusted institutions, and steady globalization, then you do not have diversification. You have one bet wearing different outfits. That is why the phrase gold is not broken matters. Gold may look disappointing in periods when confidence is high, credit expands easily, and paper assets are rising fast. But in periods when debt gets too large, trust weakens, and currencies are managed more aggressively, gold begins to act less like a dusty object and more like a form of financial memory. And the bigger system has been sending signals for years. Global debt has climbed to levels that would have seemed extreme in earlier eras. Central banks have been buying large amounts of gold, not because they are sentimental, but because they understand reserve risk. A reserve is what a nation keeps for safety and settlement when the world gets rough. That matters because central banks sit closest to the plumbing of the system. They see the pressure in a way retail investors never can. When they diversify part of their reserves away from pure paper claims, they are not making a fashion statement. They are acknowledging a world where trust may be less automatic than it used to be. If your retirement plan assumes the next 10 years will feel like the last 10, is that a plan or just a memory? That is not a cynical question. It is a practical one, and it is worth following this channel for answers that begin where old assumptions end. Now, a fair objection shows up here. People say gold had long stretches where it went nowhere. They say it can be volatile. They say it does not create income. And over very long periods, productive businesses have done much more for wealth than a metal ever could. All of that is true. But that argument quietly changes the job gold is being asked to do. Gold is not there to replace every growth asset. It is not there to out-innovate companies, out-rent apartments, or out-earn a strong business. It is there to sit outside the debt chain and give a portfolio something that does not depend on confidence staying high. That role becomes more important when real yields start moving in unstable ways. A real yield is the return you earn after inflation takes its bite. If a bond pays 4%, but prices are rising by 3%, the real gain is only about 1%. And if inflation surprises on the upside, that protection can disappear fast. This is why gold often confuses people. They look at headlines and expect a simple one-to-one relationship. Inflation up, dollar up, gold down, rates up, gold down. But life is messier than that because markets price not only what is happening now, but what people fear policymakers will do next. Gold reacts to trust, liquidity, war risk, debt pressure, currency management, and the hidden stress inside real returns. Liquidity means how easy it is to move money and assets without causing panic. When investors suspect that the value of money itself may be managed more aggressively, gold starts to matter for reasons that go beyond a normal inflation trade. It becomes part hedge, part signal, part insurance. Look at the world through that lens and the picture changes. You have nations running large deficits year after year. A deficit means spending more than you bring in. You have aging populations, expensive welfare promises, higher military spending, reshoring of supply chains, and political systems that find it easier to promise more than to cut back. All of that points to one uncomfortable reality. The future probably needs more government borrowing, not less. And if borrowing keeps rising while growth stays uneven, then policymakers will keep searching for ways to make the debt bearable. History shows that when debt becomes too large, the value of money often carries part of the burden. That does not always mean dramatic collapse. Sometimes it looks much softer. Your wages rise, but your costs rise faster. Your savings statement looks stable, but the things you need drift further away. The system keeps functioning, but ordinary people feel they are running harder just to stand still. Would you still call your strategy safe if it protects the account balance but not the life that balance is supposed to support? That question is worth sitting with. And if you want more of these slower, deeper conversations, keep this channel in your field of view. They matter most when the noise gets loud. There is another reason this title hits a nerve. Many people were taught that diversification meant splitting money between stocks and bonds and maybe holding some cash. That framework worked beautifully in a 40-year period when interest rates were mostly falling and globalization kept prices tame. But that period may have been more special than people realized. When rates fall over many years, bonds do more than pay income. They also rise in price, which gives investors a second layer of support. That was a huge gift. It made balanced portfolios look almost magical in downturns. But gifts from one era often become expectations in the next. Then came a year like 2022, when both stocks and bonds fell hard together. For many investors, that felt unnatural, but it was not unnatural. It was simply a reminder that when inflation becomes the main problem, the old relationship between assets can break. And once that happens, the question changes. It is no longer only about return. It becomes about regime. A regime is the kind of environment you are living in, the set of forces that shapes what works and what does not. In one regime, growth is weak, inflation is low, and central banks rescue markets with cheaper money. In another, inflation is sticky, debt is high, and policymakers are trapped because cutting too much risks prices while tightening too much risks recession and debt stress. Those two worlds demand different playbooks. Ray Dalio has spent years talking about big cycles, not daily market noise, not one election, not one inflation print. Big cycles of debt, money, power, and trust. And in those cycles, gold tends to show up not as a hero, but as a witness. It witnesses when paper claims multiply faster than real value. It witnesses when governments promise more than taxes can comfortably fund. It witnesses when reserve currencies still dominate, but more countries begin quietly preparing for a world with more fragmentation and less faith in one center of gravity. That is why central bank buying matters so much. The dollar is still powerful. It remains the main reserve currency, which means it is still the world's central money for trade, debt, and savings. But reserve status is not a law of nature. It is built on trust, liquidity, military strength, legal stability, and the belief that rules will remain broadly fair. Once politics, sanctions, debt issuance, and global rivalry start pushing against that trust, some countries begin looking for neutral assets. Neutral does not mean perfect. It means harder to freeze, harder to print, and harder to politically reshape. Gold sits in that category better than most financial assets. Now let us bring this back to the kitchen table. Imagine a couple in their early 70s. They own their home, have a modest retirement account, some cash, and a portfolio built on the advice they received over 20 years. They do not care about ideology. They care about keeping the lights on without becoming a burden to their children. What hurts them first is not a market chart, it is sequence. Food goes up, medicine goes up, insurance goes up. Then the supposedly safe side of the portfolio does not protect them when the risky side falls. That is how broken playbooks show up in real life. And once confidence breaks at the household level, people change in quiet ways. They spend less freely. They postpone repairs. They help their adult children less. They stop trusting official reassurance as easily. A macro problem becomes a family mood before it becomes a headline. So where could this go next? There are at least three realistic paths. The first is that inflation cools, growth slows, central banks cut enough to stabilize the system, and the old mix of stocks and bonds starts working better again. In that world, gold may remain useful, but it does not need to dominate the story. The second path is more stubborn. Inflation does not explode, but it never fully dies. Rates stay higher than people got used to. Governments keep borrowing, and returns become more fragile because both bonds and valuations carry more pressure. In that world, gold becomes less of a trade and more of a portfolio anchor. The third path is the most disorderly. Debt stress, recession, or a geopolitical shock forces a major policy response. Policymakers then choose rescue over purity, which means more liquidity, more financial repression, and more pressure on currencies over time. Financial repression is when the system quietly keeps returns below inflation so debt becomes easier to carry. That phrase sounds technical, but the experience is simple. Savers feel penalized, borrowers get relief, asset owners with scarce things do better than people holding too many paper promises. And once again, gold does not have to be exciting to become important. Some viewers will still resist this. They will say every generation thinks its crisis is unique. They will say human progress always wins in the long run. They will say betting against innovation has been a losing game. And again, there is truth in that. Human progress does win over long stretches. Innovation matters. Productive assets matter. Owning strong businesses over time is still one of the best ways to build wealth. But none of that erases the need to survive the periods when the monetary backdrop turns hostile to the exact mix most people were told was enough. That is the heart of the title. Gold is not broken. It is doing what it has always done. It is sitting outside the promises, outside the earnings call, outside the policy speech, waiting for the moment when too many people realize that their definition of safety was built on trust, staying cheap and abundant forever. If that shift in thinking feels bigger than a normal market story, it is. And if you want this channel in your life when the headlines get noisier and the signals get more important, subscribe here. These are the moments when calm thinking becomes a real advantage. Noise is expensive when the world is repricing trust. So how should a normal person think about this without becoming extreme? Not by dumping everything and hiding in metal, not by turning every week into an apocalypse, and not by pretending that the old playbook still works just because it once did. The answer is balance with better assumptions. Better assumptions start with humility. The future may not reward the same mix that worked from the early 1980s through the era of near zero rates. Debt is heavier now. Politics are rougher. Supply chains are less smooth. The world is more fractured. And money is more political than many investors were trained to believe. That means resilience matters more than elegance. A resilient portfolio can handle more than one environment. It owns growth, but it also respects inflation. It values liquidity, but it does not worship cash. It accepts that bonds still have a role, but not the same role under every regime. And it leaves room for assets that are nobody else's promise. It also means thinking in layers instead of slogans. What is your spending money? What is your emergency money? What is your long horizon growth money? What protects you if inflation stays sticky, if rates stay high, if the dollar remains strong but purchasing power still erodes, or if a shock forces another wave of money creation. Once you ask those questions, gold stops looking like a religion and starts looking like a tool. Maybe not the whole toolkit, maybe not even the main one, but a tool with a specific job in a world where debt levels, policy choices, and geopolitical fractures are no longer side notes. They are the stage itself. And one more thing often gets missed. Gold does not only protect against inflation in the narrow sense, sometimes it protects against institutional disappointment, against the slow realization that systems meant to reward prudence can, under pressure, reward debtors, scale, leverage, and political access instead. That is a different kind of risk, but it is very real. People feel that risk before they can name it. They feel it when their bank savings lag life. They feel it when house prices outrun salaries. They feel it when every rescue seems to help asset owners first. By the time they start asking deeper questions, the old confidence has already been spent. So no, this is not a story about worshiping gold. It is a story about respecting the age we are in, an age of large debts, aging demographics, louder politics, and a monetary system asked to solve problems it was never designed to solve cleanly. In that world, old assumptions can become the most dangerous assets in the portfolio. The greatest mistake is not missing one trade. It is mistaking a change in regime for a temporary inconvenience. It is believing that because the old strategy once felt wise, it must remain wise under any set of conditions. History is not that generous. The people who adapt best are rarely the loudest. They are the ones willing to update quietly before the crowd is forced to update loudly. They do not chase every panic. They do not dismiss every warning. They watch where trust is thinning, where debt is rising, where policy is cornered, and where false safety is still being sold as common sense. If that kind of thinking helps you see the world a little more clearly, keep this channel close, not for daily excitement, for perspective, because in the years ahead, perspective may matter more than prediction. The old shortcuts are losing their magic. And that brings us back to the coin in the drawer. It did not become smarter. It did not innovate. It did not reinvent itself. The world around it changed. And suddenly the thing that looked useless began to reveal the weakness of the things everyone called sophisticated. That is why the title lands so hard. Gold is not broken. The belief that every cycle can be navigated with the same neat set of paper promises is what is broken. And once you accept that, you stop asking whether gold belongs to the past and start asking whether your assumptions do. Because the most dangerous loss is not in your portfolio. It is in your map.